This single piece of paper can be the difference between keeping millions or donating that needlessly to the IRS. Because there's actually a legal way in the US tax code to sell a business and exclude massive amounts of gain from federal tax. It's called QSBS under Section 1202. But here's the catch. Miss one requirement, one timeline, one documentation step, and the entire benefit disappears. So in this video, I'm going to show you what QSBS actually is, what changed recently under the new law, the requirements that you must meet, and how we actually implement this in the real world for founders who are building for exit. If you're new here, my name is Edward Collins. I'm a lawyer specializing in tax, estate, and business law, and for nearly 30 years, I've been helping high-income earners keep more of what they make, protect what they build, and pass on wealth to the next generation intentionally. Let's put some real numbers on this. Let's assume you sell a business for $10 million and that your basis was $1 million. That would be a $9 million gain in this scenario. At the federal level, the long-term capital gains plus what is called the net investment income tax, collectively that could hit 23.8%. That would be $2,142,000 to the IRS. And then people get shocked when they learn that the state that you live in can take another bite. And if you're in California, well, you could be staring at a very painful tax bill because California doesn't actually conform to what I'm about to share with you in just a minute. It's important to know most exits don't actually fail because the business wasn't valuable. They fail because the owner didn't actually plan for the tax event. And if you're building for an exit, your entity choice isn't paperwork. It's actually the tax outcome. Section 1202 is the qualified small business stock exclusion. And in plain English, it means if you basically own a qualified stock in a qualified C corporation and you hold it long enough, you could potentially exclude a large amount of gain from federal tax. Historically, the cap was the greater of $10 million or 10 times your basis. But there's an important update. You see, under the One Big Beautiful Bill, which was signed into law on July 4th, 2025, the QSBS got a major upgrade for stock acquired after that date. The maximum exclusion is now the greater of 15 million or 10 times your basis. QSBS is not a loophole. It's a deliberate tax policy designed to incentivize investment in operating businesses. I'm going to give you what I call the QSBS scorecard. It's 5 requirements. Miss one and you don't have a QSBS. Requirement number 1 is it must be a C Corp. This is stock we're talking about. That means a C corporation structure, not an LLC, not an S Corp. QSBS literally means qualified small business stock. Requirement number 2, the gross assets test. At the time that the stock is issued, the company must be under the gross asset threshold. Historically, that was $50 million. Big number. And after the One Big Beautiful Bill, the gross asset threshold has now increased to $75 million. Now, the asset test is not about valuation, it's about the rule book. Requirement number 3, you must acquire the stock at original issuance, meaning you generally must acquire it from the company, not by buying shares from someone else. This is where documentation becomes life or death. Requirement number 4 is a 5-year holding period test. You see, you need to hold the stock for more than 5 years in order to get the full QSBS treatment. In other words, 100% of the exclusion of the full amount of excludable gain. And yes, the July 2025 law introduced some additional nuance regarding the holding period. Specifically, there's now a 50% exclusion available if you hold the stock for 3 years and 75% exclusion if you hold it for 4. The clean wealth rule here is still going to be planned for 5 years minimum. Requirement number 5 is what is called the active qualified trader business test. This is where people actually can get wrecked because you need an active operating business and some industries are just excluded, especially those businesses where the principal asset is the reputation or skill of employees. Now, QSBS doesn't reward high income. It rewards qualified operating businesses. This is why most people who may think that they qualify, they actually find out when the IRS starts reading what their business actually does that they don't. Now, if you'd like to know which business types are excluded and which ones are likely eligible, all you need to do is jump into the comments, let me know, and I'll send you some additional information. We're going to up-level this discussion here. There are certain kill switches that erase QSBS in the real world, even when founders think that they're fine. Kill switch number 1 is state taxes. See, even if the QSBS is perfect at the federal level, state treatment can be brutal. As an example, California, they actually don't even conform to QSBS. And there are several other states that don't conform or only partially conform. And a federal win plus a state loss is still a loss in my book. Kill switch number 2, the documentation gap. You need to be able to prove original issuance, the dates, consideration paid, and that the corporation actually met the asset test at issuance. If you can't prove it, you don't get it. Kill switch number 3, that's the we started as an LLC problem. Yes, you can convert, but when you convert to a C Corp and issue new stock, the QSBS clock generally starts on new issuance. You can't retroactively fix time. Kill switch number 4 is misunderstanding the exclusion cap after the 2025 update. You see, people keep quoting the old numbers all across social media, so beware. Post July 4th, 2025 stock, it has a different cap. It has different thresholds. And if you're building today, you need to plan under today's rules. Here's how we actually implement QSBS inside of UPLEVEL for the founders that we serve that are building for an exit. Step 1, we decide if the business model can even qualify. Not can you incorporate, no, can you qualify? Step 2, we actually structure the entity. We structure it the right way from day one. A C Corp if QSBS is the goal. Step 3, we document the stock issuance properly. Board consent, issuance docs, cap tables, consideration dates, a clean paper trail. Step 4, we actually keep QSBS file and we keep it as it grows. Because 5 years later, you don't want to have to go through reconstructing history. Step 5, we coordinate state planning early. Because again, federal QSBS without state planning is only half a strategy. QSBS isn't a tactic that you add later. It's actually a design decision that you want to make early. Now let's lock in some non-negotiables. Non-negotiable number 1, QSBS starts before you need it. You see, if you're thinking about QSBS at the closing table, well, you're 5 years too late. Non-negotiable number 2 is that you must track issuance dates. The clock starts when the stock is issued. You're going to need proof, so track early. Non-negotiable number 3 is that you must know your state exposure. Your state of residence at the time of sale can determine whether you actually get to keep the full win. Non-negotiable number 4, your business must stay qualified. Your operations matter, your assets matter, your business category, it matters. Here's the big takeaway. QSBS is one of the most powerful tax benefits in the US code for founders and early investors, but it is fragile. If you get it right, you could potentially exclude a massive amount of gain from federal tax. And if you get it wrong, well, you get the same tax bill everyone else gets, plus regret. If you got value from this, hit like and subscribe because it actually helps the channel and it helps me to keep sharing this with people who deserve to see it. And if you're building a real company and you want structure for a real exit, tax strategy, entity strategy, asset protection, and legacy planning, well, that's exactly what we do inside of UPLEVEL by Design. So just jump in the comments and let me know if you'd like to learn more. Bye for now.